If you want to take funded account payouts, that's cool, but you have to have a strategy. And to have a strategy, you have to have a foundation. So if you don't have your foundation, watch this video and let's get into it. What's up, everybody? I'm Andre. I'm the founder of Take Shift Academy, and today we're covering swing highs and swing lows, the foundation of everything. Alrighty, so swing highs and swing lows are the foundation of market structure. Before you can read liquidity, find fair value gaps or any other PD rays, or place a single trade with precision, you need to understand swing highs and swing lows. Every level in the market starts there. What is a swing high, you may ask? A swing high is a 3-candle formation where the middle candle has a higher high than both the candle to its left and the candle to its right. No confirmation needed, no displacement, just 3 candles where the middle one is the peak. So here, if you look at this 3-candle formation, you see we have a 1, a 2, and a 3. The 2 has a higher high than the 1 and the 3. So when you're looking at your 1, 2, 3 candle pattern, does the second candle have a higher high than the candle to the left and the candle to the right? And in this swing high situation, we are only looking at the candle wicks. So we want to get that highest price offered, which is this swing high here. A swing low is the exact same concept, but in reverse. 3 candles where the middle candle has a lower low than both the left and the right candles. The middle candle is the bottom of the formation and there are no extra rules. So here in this 1, 2, 3 candle pattern, you can see that the second candle has a lower low than the candle to the left and the candle to the right. So the second candle has a lower low than the candle to the left, which is the 1, and the candle to the right, which is the 3. So 2 in our swing low using that wick. Why are swing highs and swing lows important? Because every single swing high and swing low tells you something. It tells you a piece of information, tells you where liquidity rests, tells you what the market structure is. They all give you crucial information to better your trading. But every swing high and swing low is a level that liquidity rests at. Retail traders are taught to place their stops above and below swing highs and lows. The market knows exactly where those orders sit and targets them. So here, if we look at this diagram, we have a 1, 2, 3, 4, 5, 6, 7 candle pattern with a swing high here, a swing low here, and a swing high here. Above your swing highs will always rest buy side liquidity. And how do we find a swing high? Let's imagine that we have another candle here that is lower than candle number 2. So we're going to have 1, 2, 3, with 2 giving us our swing point and putting a swing high. And then we're going to have 1, 2, 3, with 2 giving us our swing point and giving us our swing high, and buy side liquidity rests up above. So meaning if the market is gravitating higher, it's gravitating towards that buy side liquidity. And the same exact thing goes for the sell side. So here we have a 1, 2, 3 candle pattern where you see the second candle puts in a lower low than both the left and the right candle, both the 1 and the 3. So here we have a swing low, and this is where our sell side liquidity rests. Now let's get into some real chart examples so I can show you exactly how you can use this. Alrighty, so welcome to the live chart. As you can see, we are on the daily time frame and we're going to go over some swing highs and some swing lows in a real chart example. So looking at this chart, what do I see? A swing high here, a swing high here, and another swing high here. Now when I'm looking at these swing highs, how do I identify that they are swing highs? Well, let's start right here. 1, 2, 3 candle pattern. Is candle 2 higher than the left and the right? No, candle 2 is not. So we go to the next. 1, 2, 3 candle pattern. I'm looking at candle 2. Candle 2 has a higher high than the left candle and a higher high than the right candle. So this gives us a swing high. Here we have another 3 candle pattern. 1, 2, 3. We have a higher high than candle 1 and a higher high than candle 2. So this gives us another swing high. And then we have the final thing down here. And this is a great example because as you can see, this here is barely higher than the candle to the right, but it is still a higher high. So this is another swing high. And what do we know rests above these swing highs? We know that liquidity rest above these swing highs. So we can expect that the market will gravitate towards the liquidities because the market is always targeting liquidity. Now let's switch to swing lows. What do we have here? Looking at this 3 candle pattern, we have 1, 2, 3, where this candle is the lowest low. Here we have a 1, not lower, 3, not lower. So here we have a swing low. And here, in this case here, now you have identified your swing highs and swing lows. So you can have an idea on where price is going to gravitate. And this is how you can use this on the higher time frame to identify where price may be going. But let's switch down to a lower time frame so you can get some more examples. Alrighty, so we are on the 1 minute chart. And what I'm going to do is the same exercise we just did. So here, what do we have here? A swing high. And why is this a swing high? Because on the 1 minute chart, we have 1, 2, 3 candles, and this second candle puts in a higher high than the left and a higher high to the right. So this makes this a swing high. Now I'm going to look over a little bit and I'm going to draw this one out. And I want you to think, why wouldn't this be considered a swing high? Go ahead and pause the video real quick because I'm going to get into the answer. This right here would not be a swing high anymore because it has already been taken out. It has already been, the objective has been met here. If you could have drug this line over to the right and there was no mitigation, there was nothing going through this level, it would have been a relative swing high. But whenever you drag your line over to the right and you see the level has already been mitigated, has already been taken out, this is no longer a relevant swing high in the market. So you no longer need this swing high. This swing high is relevant. But this one no longer is because it's already been taken out. So here we have a swing high here, a swing high here, and we also have another swing high here. So here, that is 3 swing highs right here next to each other. And what do we call this? We call this buy side liquidity. And why is that? Because traders are taught to place their stop losses above your swing highs. So this is buy side liquidity. Now let's look at the sell side. What do we have here? We have the same thing that we had here. So here, this is a swing low, but this is no longer relevant because why? The NASDAQ has taken out this objective here. So here, this was a swing low. The NASDAQ took out this objective. It still is a swing low, but it is no longer relevant and we no longer need this level on our charts. So we go to the next. This level here as well has already been taken out, so we no longer need that one. We go to the next. And here we have our first relevant swing low. So here we have a swing low that has not been taken out yet. So I can count this as a relevant swing low and actually have this plotted on my chart so I can understand where is the sell side liquidity. So what do we know rests below here? The opposite of buy side liquidity, sell side liquidity. So here, looking at this chart, you have an idea on where price is going to gravitate. We could either gravitate towards this sell side liquidity or towards this buy side liquidity using a simple 3 candle pattern, swing highs and swing lows. And if you stayed this long, I appreciate you and I'm going to give you a tip. So in this case here, when you have multiple swing highs stacked overlapping each other like this, they call these equal highs, and equal highs are a very strong draw on liquidity. So we have buy side liquidity here, but when you have a lot of swing highs stacked on top of each other, this is basically very strong buy side liquidity, drawing the market towards this very strong area because there is a lot of liquidity resting here. So that's just a little gem for your notes. Not nothing you have to master today, but it is a gem for your notes, just because I appreciate you for staying here watching the video. So let's get back to the PowerPoint. Alrighty, so we have the key takeaways from this video, the things you should understand, the reasons you should come back and revisit this video, and you have not mastered this concept until you know all of these down here. So you should understand what a swing high is, the 3 candle pattern, and how to identify it, what a swing low is, understand that you don't need displacement or any kind of confirmation, any kind of indicators ever to identify where liquidity and a swing high and low are in the market. You should understand that swing highs, there are buy stops above them. So we have buy side liquidity at swing highs, sell side liquidity, swing lows Sell side liquidity rests below swing lows, so it's the same exact thing as buy side liquidity, but opposite, sell stops rest down here below our swing low, and the market is always hunting one of these levels. The market is always hunting either a swing high or a swing low. So you should be able to master all of these topics, and when you do that, you have successfully started your foundation, and I'm looking forward to seeing you guys in the next video.